Hi, everyone. Let's talk about the upside of downside. First half of 2022, by almost any measure, was one of the most painful periods in history for investors. If we look at the stock market, we have the S&P 500 down 20%, on pace for its worst year since 2008 and third worst year in history. If we look at the bond market, we have the 10-year Treasury bond in the US down 11.5%. That's on pace to be the worst year in history for bonds. And as a result, if we look at a 60-40 portfolio, so 60% stocks, 40% bonds, they were down 16.6% in the first half of the year. That's on pace to be the worst year ever for a diversified stock bond portfolio. If we look at the corporate bond market, 13.9% decline for investment grade bonds, on pace to be the worst year ever there. And high yield bonds or junk bonds were down 14%, on pace for their worst year since 2008. Lastly, if we look at REITs or real estate investment trusts, they were down 19.3% in the first half, on pace for their worst year since 2008. So, what's going on here? Why is everything going down? Well, there's really no shortage of rationales, no shortage of bad news to pick from. We have the highest inflation rate in the US since 1981, so you have to go back a long, long time. And this is causing a lot of fear and anxiety out there. Then you have the Federal Reserve reversing the easy money policies of the prior few years by tightening policy. They hiked rates three times in the first half of the year and are expected to continue to hike rates throughout the remainder of the year. You also have the war in Ukraine and the impact that's had on food and gas prices, which hit record highs in the first half. And finally, you have the US consumer, and consumer sentiment for all of these bad reasons has really plummeted. Wages are not keeping pace with inflation, and this is really increasing the fears of a recession in the US. So, ascribing reasons for declines is, of course, the easy part. The hard part as an investor, and the important part is thinking about what is going to happen next. And in the short run, that's very difficult to predict. If we look at the worst starts to a year in history for the S&P 500, we can see that in the back half of the year, it's not necessarily going to be the same thing. We've seen many years where there's been a snapback rally to end the year. We've also seen years, though, that have had a difficult first half, and that losses continued in the back half of the year. So predicting the short term for the markets is, of course, an impossible game to play. And if you're a long term investor, you should really try to avoid doing that. But if you look out longer term, what is kind of the data saying here? Looking at the worst 6 month periods for stocks, what we find is something interesting that if we look at 5, 10 year future returns following these worst 6 month periods for stocks, we actually see positive returns every single time in the past and actually above average returns as well, which is important because if you're investing and you're just picking a time period where you're going to invest, you're better off investing after a sharp decline than just any random time period. And there's a good reason, there's a good rationale for that. It's because when stocks go down hard, they tend to become cheaper. So the valuation tends to fall, and valuations are inversely correlated with future equity market returns. As you can see in this table, the highest valuations have the lowest future returns, and the lowest valuations tend to have better long term returns. And that's an important concept. And that really brings us to where we were at the start of this year. In the losses that happened in the first half didn't happen in a vacuum. What we had to start the year were among the highest equity market valuations that we've ever seen. So you had to go back to the dot-com bubble to find a higher CAPE ratio, which is a valuation metric for the S&P 500. And for the 10-year Treasury yields, we had amongst the lowest yields in history. So what we've seen in the first half of the year has really been a mean reversion in both of these factors, with valuations coming down and yields going up. Now, that mean reversion, of course, has been painful for investors as stocks have fallen and bond yields have risen, and of course, bonds then have fallen as well. And in the short run, that is a very painful factor, but in the long run, it's actually good news for investors. And the reason for that is if we look at every major asset class that we talked about here, they're actually in a better position today than they were at the start of the year. So there's a higher yield today in treasury bills, treasury bonds, investment grade bonds, high yield bonds, REITs, and stocks than where we started the year. And that's extremely important because higher yields tend to pave the way for higher future returns. So, with all that bad news in the first half of the year, the good news is if you're a net saver, if you're a long term investor, if you're adding to your accounts every month, you're reinvesting dividends or reinvesting interest payments, well, now you have the higher expectation of future returns. So, that's the good news for investors today. That's the upside of downside.